Paul Dietrich, a CEO and Chief Investment Officer at Fairfax Global Markets, joins us from New York. Paul, thank you for joining us. Good evening to you. There's some buzz through the markets that corporate tax cuts could be phased in. Won't be immediate, but it will take 5 years to phase in down to 20%. Your reaction to that?
I think this is really good news. What the markets are looking for is certainty, and the fact that it's phased in over 5 years, I don't think it'll make any difference so long as we know when it's going to be phased in and that it's going to happen. And I'll tell you why this is probably good news, is that when the Republicans passed the budget reconciliation legislation, they added $1.5 trillion in debt to the budget to take up the slack that we expected from the negative impacts of this tax reform. And what this means is that the cuts that they're proposing are probably larger than what most analysts expected, and that's the reason it would take the $1.5 trillion debt higher. And the reason why this is important is that this is the way, this budget reconciliation is the way that the Republicans can pass this tax reform bill with only 51 votes in the Senate rather than 60. And so they have to keep that $1.5 trillion over the next 10 years in mind. And what this means is the cuts are even more significant. I think analysts will like this. And the fact that there's some certainty and it's phased in over 5 years, I just don't think that will make any difference.
That's the plan, Paul, but it's getting a lot of pushback, even from those you would think normally are aligned. The National Association of Home Builders has mounted a pretty high-profile campaign against the whole thing because it targets mortgage deductions, and then the deductibility of local and state taxes puts Republicans in high-tax states like California and New York on the defensive, and then there's the whole 401k deductibility issue. I mean, there are a lot of holes in this plan.
Well, I wouldn't call them holes. This is the negotiations that are going on in trying to get rid of tax loopholes. I mean, this is true tax reform. Most of the people I talk to on Capitol Hill are telling me that there will be compromises on probably all three of these issues. There may be some lowering of the 401k, how much money you can put in any given year. There's going to be some, the mortgage deduction is going to stay. What's probably going to happen is that second home mortgages, and there may be a cap for multi-million-dollar homes for mortgage deductions. And it's the same with all of these other things. There are going to be some compromises, and that's to be expected. This is true tax reform.
Mm-hmm. So, Paul, if tax reform is coming, then we have to kind of take a look at strategy. And I would imagine an obvious one would be companies that derive a lot of earnings from the U.S., not so much multinational companies with revenue streams overseas, but the bulk of their revenues at home.
Well, this is the most important question, is how is this tax reform going to affect investors? And it's going to be very, very big, because although we're lowering the highest marginal tax rate of 35% down to 20%, is that certain companies are going to get massive benefits and increase in earnings, and their PE ratios are going to change. And there are some companies, especially global companies, that pay lower taxes because of tax loopholes and because they can park money overseas and not bring it back to the United States, which is going to be taken away in the new tax reform legislation. Those people are going to have a hit to their earnings, and their PEs are going to rise. So what's going to happen is that every price-earnings ratio of every company in the United States is going to change after this. You get a company like Verizon, it's selling for about a 12-something price-earnings ratio, and it pays the full 35% tax rate, and its its PE could really drop significantly, and this is a company that has a 4.8% dividend yield. That's not going to last for very long. It's going to go up, and that's going to happen with a lot of companies. And so this is a once-in-a-generation event of where all the PEs are going to be restructured. We haven't seen this since the 1986 tax reform. It's also going to make changes to the overall market because, let's face it, we use the PE ratio as of the S&P 500 to determine whether the market is overvalued or undervalued. And analysts are looking at it, and the average tax rate paid by most, the average S&P 500 corporation is about 24.17%. And so when that goes down we have a forward PE right now as of last Friday of 17.6. That would go down to about 15.9 with this tax reform if we go from 35% to 20%. That would revalue the market just a little bit over the last 5-year average, which is 15.6. So the market doesn't look overvalued when you take into account this tax reform legislation.
Yeah, no, 15.9 doesn't look overvalued at all. Very important point there. Paul, thank you for your time. Paul Dietrich, Fairfax Gold Markets, with us from New York. Now let's get to